Welcome to the market wrap for March 1st, 2019. This is Ifan from the Strategic Day Trader. We got the market up about 0.7 and the SPY up 0.57, just lagging the Qs a little bit, but a nice recovery here off of hourly support here on the Qs and SPY. So what we discussed yesterday was that we had a pretty narrow range day, tried to go up and then came back in. Really nothing notable happened. And then today we got this gap up, right? Market opened up higher. And as we discussed, if we get over this double top here, which was an hourly sell setup, then we're all out bullish. Okay, market came in, tested the support, right? And then we went right back up. So Qs actually got to new highs. SPY, I think, hasn't got there, may not get there. But we are going into next week all out bullish. I don't really see any other way to be. We've been either bullish, mostly bullish. At times we've been neutral, like in here, and for a short period of time in here. But for the most part, we've been bullish, as this is just your standard following the trend. We've been looking at the hourly, potential hourly breaks of the trend to look for an opportunity bearish. The only thing that we've really changed at times was that when we did break the hourly uptrend is go to neutral until we recover. And so for the most part, that's kept us in the right direction. I mean, we've been mostly bullish throughout this run-up, and it continues. And if you recall, I think probably last week I said, as long as we continue to base out, the longer that we take to go higher, the more bullish. Okay? We don't really want to go right away. That makes the market more susceptible to a breakout failure. The more that we base, should be the stronger the move that we get. Okay, so all out bullish going into next week, okay? Because we're bullish on the long-term time frame. We got the daily uptrend, weekly grind, okay? And then the hourly is now resuming the uptrend, okay? So what would it take for us to lose the bullish bias? First would be in the short term. If we get back below 170 to 70 on the Qs and back below 278.30 on the SPY, then we will be back to a neutral short-term bias. For the long-term bias to change from a bullish bias, we do have a buy set up here, so we would have to shift to neutral if we get under 277.48. Because this hasn't cleared the pivot on the Qs or the SPY. Well, maybe the Qs have here 174.66 and 17. Yeah, we haven't cleared on the Qs either. It's not a significant pivot yet, so the only significant pivot is still this one down here. Okay, so the daily, you know, we could get a big gap down. Anything could happen, right? But for now, you know, the long-term bias isn't really is susceptible to any kind of trend change right now, unless we get something dramatic to change things. But I think if we're going to talk about where we can shift back to a neutral short-term bias, meaning hours and days, as opposed to days and weeks for the long-term bias, then we'll be looking at this support area here. Okay? All right. So let's get into the triple D, which the triple D, the numbers were given this morning on the triple D, 1350 by 1380, but I wanted to go over the additional setups that this gave, right, and introduce the idea of the add and reduce, okay? So there's a lot of different ways to use the add and reduce strategy. It's more of a management style, but let me go over the triple D and kind of where the concept for the short came from. So it was a gap up that broke through support. I thought this was a good day to go over this strategy because it's a little bit different. I think people get confused sometimes that, like, when the Qs were getting sold, that this was burying the gap, say, like in the first hour, right? Like the Qs did get sold, but it never broke through support, right? Here's minor support, here's major support. Never broke through support. It buries the gap when it gets through the support. Okay, so in order for the Qs to really bury, say it had buried the gap, what would it look like? For me, I would at least have to get through the previous day's low. That's usually going to be some hourly support. Yeah, that would have to be the starting point. Next area of support would be the bottoming tail. Now on the triple D, right, where's the support? Here, 1360. And what did it do at the open? It blew right past it, right? Got sold right at the open, all the way down to, like in the first 5 minutes, right, down to here. Okay, so we blew through that support. Okay, so then on any kind of retracement, you want to look for an opportunity to get in. Okay, so I'll show you where the numbers came from. It was a 1 minute and 2 minute sell setup, right? Here's the 1 minute. Came in, got the retracement after we broke the support, right? And then underneath this red bar here, 1360, okay, by 1390. Okay, so that was the first entry. Okay, now let's talk about what is the add and reduce. And so add and reduce stands for adding shares and reducing your risk. Okay, so that does seem like, how could that be possible? Okay, because that seems like if you add shares, then you will be increasing your risk. Okay, so what we got was a base here. So you need another setup after the first setup has worked, and you need another setup. So what we got here is a base at the lows. Okay, so the low here on this bottoming tail was 1270, and then this was 1291. So say you weren't in the triple D, you could just play this straight up as a breakdown, even if you had missed this one. But say you had gotten it, and now you want to add more shares and then lower your stop to 1291. Okay, so we'll look at what that would look like. So let's say you risk on this 40-cent stop, you risk 600 shares, right? Say if you use like a $250 to $300 stop, that means if this play triggers out, right, triggers you in, you get 600 shares, and then doesn't work, right? Say this next bar, instead of being a wide range red bar, goes all the way back up and takes out 1390. Oh, sorry about that. Let's go back. Takes out 1390, right? Instead of this red bar, it was a big green bar and took this out. Took this out, you would lose about 250, right? $250, 40 cents per share. Now, because it worked, right? You're on those 600 shares, you're now up, right, on this. Now you want to add more shares and then reduce your risk. So on those 600 shares, even if it takes out 1290, you're going to be up on those shares. So you can actually add more shares, and then if the shares that you added don't work, you end up not losing. Okay, so here's how that's going to look. Okay, so you start off 600 shares, right? And now you want to play that new breakdown and add shares. But let's say you don't want to lose a total of 250 like you would, or 240, depending on slippage, 250 like you would have, initially. Because you can add actually 2,300 shares, and then if this takes out this 290, then you'll lose what you initially risked. But you'll get to have added almost 4 times as many shares as you started with. Okay. Now let's say you don't want to lose that much. Say you're like, okay, I'm just going to add as much so that if the shares added stop out, I'm going to be break even. You get to add 1,300 shares. You get to double your size, or add twice as many shares, so you actually triple your size. Okay, at 1270, right, on this breakdown. So hopefully that makes sense. I know you may not have this calculator set up. It's very easy to set up once you understand the concept, right? I just did this myself. I give it to all the coaching students. It's just a little Excel worksheet, and you can just have this and then put in whatever necessary numbers you need to put in, and then these like grade boxes like figure it out for you, how many shares you get to add. Okay, so even if you add 1,300 shares, when this breaks 1270, right? You now have 1,800 shares. You now have 1,800 shares. If this doesn't work, you're at break even. Okay, so it gives you the opportunity to really capitalize on this really, really big mover, right? Which was a really good gap berry. All right. What if you say you took half already, right? This came in and you took half down here at 13 on half of those shares, right? So you made $120. Okay, so you already locked in $120, right? And now you want to add to it and you're saying, well, I don't want to risk more than what I already locked in. So maybe I'm only willing to risk, $120 on whatever else I add. You get to add 1,800 shares. You get to quadruple, right, what you initially started with. And so now with the 300 that you have left, right, yeah, then you'll be left with adding another 1,100. Okay, so it gives you a chance to really maximize how much you get on these movers, right? I don't know if you guys have heard of the turtle traders. They did this a lot, right? I forget who was their kind of the leader for them, but they were known as the turtles, and they would just continue to add to winning positions. So this, by having another position or another pattern set up here, gives you the opportunity to add to it, right, without risking more, right? So that, or even the chance to reduce your risk. Okay, so once you understand that, it's pretty easy to kind of figure this out if you wanted to do this on your own. Otherwise, usually in the room or in coaching, I'll give it to you. And so with this, right, it's a very different scenario of having 300 shares or 600 shares working its way versus 2,400 shares, right? So, and even then, you stand to gain a lot without really even risking more than $250 like the most you can lose, and then you can reduce your risk. You can go to even make it a free play and still add shares if you want after you took half, right? So then you'll have a locked in $120. So what makes this most powerful, there are a couple things that you want to be on the lookout for in order for the best add reduce opportunities, which is one, the second entry needs to be in the money, right? In the money, so that way you have some locked in profit, and then the play needs to be working. So don't get this confused with averaging down, right? Where the play is not working, you're losing money, you think, well, if I short some more here, I'll have a better average. That's not, we don't ever do that in the room. Maybe there's situations you could, I never do that. If the position's not working, it's telling me that I'm on the wrong side of the play. I don't want to double down or average down on it. I think that just puts you in a position for some disasters. And while most of them may not turn into disasters, it really only takes one. So it's only on positions, right, that are working, right, that you can lock in profit. Otherwise, the reducing risk part doesn't really come into play unless the play is working in your favor and you get a chance to lock in profit. And then you basically use that profit, right, to add additional shares. Okay, hopefully I explained that well enough that makes sense. Okay, now what some other people do in the room is they'll add and reduce, but they'll start off with smaller share size. Like say on this triple D, they weren't sure. So maybe they'll only start with a smaller position. And then once it proves itself that it's working, then they'll go full. You can do that too, if you would like. That's another way to add the reduce, to use the add and the reduce rather than, right, try to maximize one that you're going after to also get a position in something that you think looks good, but maybe there's one or two issues with it. And then once it proves itself, then you can go full on that position, right? So that's another kind of way, I guess, to approach it. But as far as, stuff like this, I generally try to only play the plays that I'm 100% on, like I feel, or like I'm committed to. Like if there's any problems with it or whatever, for the most part, I try to pass on them. It's only, yeah, sometimes I feel like, okay, there's one or two issues, but the reward to risk is so good, maybe, we'll give it a shot. This was just overall a very good gap berry. There's a few videos on the Strategic Day Trader playlist about this concept, about this strategy, and what kind of entries to look for. Okay, so you're welcome to you can probably just search it and you'll find that term, the gap berry or the gap bully. The gap bully is just when they gap down and then reverse the gap. So it'd just be the opposite. Something gaps below support and then runs through resistance. So that's going to be pretty powerful as well. I think on this LRN, probably on this day, did have a good add reduce opportunity here, but you can see a gap down and then powers through the resistance there. So usually these do also follow through on the days to come. I don't have a good swing strategy to capitalize on these at the moment, but that will be in the works. So yeah, something like this CONN, see this gap berry here, gapped up and then sold through support, right? Usually they do follow through lower if it's a gap berry, and then follow through higher if it's a gap bully. So yeah, I think it's a very powerful concept, the gap bully, gap berry itself, and then you can really maximize some of these plays with the add and reduce. Now, just to be fair, does adding to it, does committing more shares, could you potentially turn a winning play into a losing play, or a winning play into a break-even play? You could, right? That's kind of the downside to it, or not necessarily the downside, but the potential flip, or the scenario that could happen that it doesn't work in your favor. Okay, so let's say, right, you played this breakdown here, right, and instead of giving that follow through, it triggers right there, and then suddenly you get this pop and it goes through the base, right? So that's why you want to have something like this, so you can say, well, if it doesn't work, I don't want to lose the whole thing, and I don't want to lose a full risk amount. So that's why you can reduce your risk. You say, well, if these shares end up not working, these other 600 that don't work, well, these other 300 that are locked in profit will just cancel out the 600 that lost. Okay, because when it takes out 1295, right, which is the top of this base here, then these 660 will lose the equivalent of what these 300 made from initially entering at 1350. Okay, I think you guys got it, right? I think you guys got the concept. So yeah, I just wanted to go over that because I thought that was a pretty good opportunity today on the triple D. And I think it's a concept that we can look at moving forward, especially as earnings season slows down. Excuse me, because we'll have less gaps and less good opportunities. So with those, we can maximize some of the winners that we get, because we don't really need to save as many shots for different setups. If there's only 2 or 3 a day that look good, then we can really start to kind of commit to those and get as much out of them as we can. Okay, so I wanted to go over this. Usually, like during earnings season, I don't want to do this too much, because I want to save as many shots, because there's a lot of different gaps and there's lots of different setups. I want to make sure, I get to take all the shots that I want to take. But usually March, beginning of April, before the next earnings season, we have less kind of things to really look at, right? Less things that are doing something significant, putting in big volume, right? And trending nicely. Okay, so this just gives you a chance to maximize plays that are going to be in a trend. Okay. All right. So that's going to do it. I thought it was a pretty good week overall. So hopefully you did well. I'm hoping that next week we still get a decent amount of gaps, but earnings season is definitely going to be winding down. Okay. So it'll be time to think a little bit more about capital preservation, and then kind of maybe working on other aspects of your trading aside from just, getting as many plays and trades as you can throughout the day as it is now. Okay, so that's going to do it for today's market wrap. We'll see what the market gives us on Monday, and I will talk to you then. All right, have a good evening. Have a good weekend.